Good afternoon, everyone. I'm Matt Truman, CEO and co-founder of All Things True. Thank you so much for coming and sparing your time to be with us today. It's worth reflecting on creative destruction. Creative destruction is omnipresent. It's worth seeing just how many life-changing technologies have been destroyed by the iPhone, the smartphone, just in the last 5 years. The potential of the smartphone is everywhere. You can live your whole life through it. Previously unimaginable power in the palm of your hand. However, are the great minds of the technology today slightly underestimating how the customers use it? Some people have got a long way to go to understand its true potential. I'm going to spend the next 15 minutes running through these 5 things. Firstly, reflecting on progress at True. Secondly, looking at whether the industry is dying. Thirdly, if it is dying, why are we even here? Why are we even interested in investing? Fourthly, what can the industry do to fight back? And lastly, what is the point of revolution and today? Paul and I constantly remind ourselves that 39 months ago, this was True's head office. Armed with a 100-page business plan that no one has ever read, we decided to enter a sector that neither of us has ever worked in. And to make it a little bit easier, we decided to build 2 businesses at once. TrueStart has looked at 2,500 startups from 38 countries and invested in 33 new companies. Some of the highlights are there in front of you. Hullabaloo rolled out to Made.com, a brilliant visual search engine. Presence Orb now sees 2 billion devices each month. PhotoSpy has become an official Facebook marketing partner. City Pantry has broken 400,000 monthly revenue run rate. And Vital's currently rolling out its product and proposition across 750 stores in the US. Added to that, we boast a global roster of brilliant institutional clients, strategic partners, people who truly help accelerate our startups. Over the last few weeks, we've added LLX to this list. LLX, for those that don't know, is the technology platform of JAB, who own assets such as Reckitt Benckiser, Jimmy Choo, Bally, Bellstaff, DE Master Blenders, Espresso Hut, and many more. With growing credibility, a brilliant ecosystem starts to evolve. And a great example is the TrueStart Advisory Board that's been formed over the last 12 months. These are disruptive leaders, people who are changing the industry in which we operate in, and we're delighted to have them alongside us as we build our business. At True Capital, since the home office days of 2014, it's gone on to make 6 investments, raised 2 institutional funds with a global investor base, and has exited its first investment, returning more than 10 times capital to our investors. We now have assets of north of £200 million, a global institutional investor base, and a brilliant team of 20 people. Perhaps more importantly, over the last few months, we've added 2 new charity partners. Tommy's, the UK leading baby charity, and Action Aid, a leading international charity operating in 45 countries, working with the poorest women and girls around the world, focusing on women's rights, ending hunger, education, and trying to limit humanitarian disasters. Such great causes have driven me to dust off the Nikes for a long overdue jog around London. Both charities are represented today, and I'll be delighted with some support. So, is retail dying? It's not, but it's pretty grim. Most are exposed to the wrong products. Most are exposed to the wrong channels. The chart here shows a perfect storm of pressures with very little consumer-led ammunition left to combat it. Consumer sentiment has turned. Although we're not at the depths of the financial crisis, we are back to levels last seen at the last .com crash. After an 11% fall, real earnings are yet to return to the pre-crisis level. This is disproportionately impacting the poorest and the youngest within society, those that are asset light. As a Lehman employee, this looks worryingly familiar. Although not driven by mortgage rates this time, unsecured credit growth in areas such as car financing could start to prompt real day-to-day consumer liquidity pressures. Productivity remains stagnant, and it remains stagnant because of historical low interest rates. This prevents creative destruction, where weaker, older, uninnovative companies are not being replaced by the young, growth, disruptive companies that feed the economy, that drive jobs and stimulate growth. Zombie companies are everywhere. Zombie companies are everywhere in retail, as is the endless search for yield, driving slow-moving, large companies to record valuations with little prospect of fulfilling that valuation. We expect a volatile response as and when it comes. Is this the perfect storm, the worst cocktail of cost increases seen by the sector? It certainly is in my 20-odd years in the space. FX, inflationary-linked rents, growing costs of digital marketing, rising oil and freight, 4.2% hike from national living wage, rates, the increased costs and the race for IT talent, and the financial and brand costs from cybercrime. It's ironic that most of these inflationary increases are impacting the slowest and actually even the most declining channels. The new General Data Protection Regulation could wipe a fine of up to 4% of overall turnover. For many retailers, that's their entire margin. All of this pressure comes before servicing a multi-channel customer with a multi-channel infrastructure with no guarantee of incremental custom. At the same time, apparently the consumer attention span is now down to 8 seconds, less than a goldfish. How do you capture someone's attention with a commoditized, unbranded, undifferentiated product? At the same time, layered on top of this, retailers have lost control of the customer journey to monopolistic global tech companies. A retailer or a brand now has to convince the gateway company to let them through first before they even see the consumer. This adds cost and complexity to the marketing function while driving down selling prices given the visibility that it provides. It's no coincidence that these 4 companies are amongst the largest in the world. One thing retailers always done and will continue to do is to adapt and change. Internet sales are now at $1 billion a week in the UK, in a market of 358 billion. It's now back in significant growth, given the power of the mobile, the fact that conversion on mobile has now been digested and understood. The market for internet retailing is 5 times that of a decade ago and double that of only 4 years ago. We continue to believe that channel shift is perhaps the single greatest driver of returns for investors in the categories that we operate in. Retail has spent basically the last century organising itself around the car and the car park. Voice, mobile, drones, driverless cars all ask serious questions over this asset or indeed liability. Organising ourselves around these key channels and understanding how we can overlay the same experience for customers is perhaps management's biggest test. Ironically, it's still unclear which one of these channels will actually work, will actually generate ROI, and therefore the allocation of capital decision is perhaps harder than ever. So, with that backdrop, why are we even here? Why am I still putting money to work in this space? The answer is because we invest in what we perceive to be the future of the industry, the business models that have relevance. Here are some of the characteristics and qualities for the future that we think about. Among those, brand ownership is arguably the only thing protecting ourselves from Amazon and the gateway companies. As you can see from the below, even the great man agrees with me. The great man also went on to say in 1980 that capital expenditure isn't paid for by the tooth fairies. And I suspect as an investor, with various accounting policies around IT and R&D, similar problems are about to surface around this policy. We're excited about the future because fundamentally we're agnostic about the failure of some of these traditional companies. At one end, capacity falls away, creating market share opportunity. At the other, these companies are weakening. They're lowering in profits. They don't have the capability to keep investing in the same way, which means you open up a divide between these young, faster-growing, relevant companies operating in the right channels and those that are weaker. We see great market share opportunity from this change. As you can see here, our businesses tend to have much more flexible cost structures, higher sales per employee, and lower capital intensity. Let me give you an example. Furniture is a fragmented but significant UK market, a £15.5 billion market, a supply chain with numerous intermediaries, wholesalers, and a sizable grey market, a low SKU count, and not one dominant online player. Ours is a direct-to-consumer brand owner, predominantly digitally driven but centrally distributed, and the advantages are clear. A materially higher gross margin from which to invest into a greater marketing efficiency and drive the business forward. Payroll, CapEx, at a fraction of the established bricks and mortar retailers. This leads to single trade economics that are materially more powerful than the existing incumbent players and a greater cash conversion from within which to invest. So, what can the industry do to react? Standing still has been proven to fail. The ROI of doing nothing is terminally negative, as you can see from these tombstones. The industry has to do something. We believe that you can either be frictionless or experiential. Managers have to decide which one it is. Amazon, you can order your groceries with one click. You can order with voice. HelloFresh and Dollar Shave Club will deliver automatically. And Casper has only one SKU, delivering one single mattress to your door. Alternatively, Tesla have reinvigorated the retail experience. Lululemon do yoga classes within their stores. And Charlotte Tilbury has built some technology that enables them to match skin tones to drive a really personalized complimentary tutorial. Some examples in the retail world of frictionless versus experiential. Sitting in the middle has been proven to fail. From ASOS's free returns, free next day delivery, and multiple brands in one global marketplace, through Lidl's simplistic SKU count, through to Selfridge's immersive retail and leisure experience. Proving the point, optimizing for the wrong thing in consumers' minds has proven to be fatal. BlackBerry decided to optimize for typing speed versus UX. Yahoo for ad revenue versus quality of search product. And Concord for speed versus cost. Thirdly, a management team must understand and strategize around the fact that digital impacts absolutely everything. Payments, inventory management, working capital, ranging decisions, marketing, store locations, and even we're seeing artists actually building their albums based on the algorithm for Spotify rather than what actually the consumers want. Choice is being lessened. We have a tremendous working capital platform here with us today, a company called C2FO, and I'd urge all retail and consumer companies to go and meet them. I gave a conference about 10 months ago talking about Amazon's four-pronged attack on the grocery market, and management need to recognize that the speed of innovation is getting quicker and quicker. 10 months on, there's now two further prongs to that attack, and perhaps these latest two, perhaps the most impactful in terms of the level of disruption. Management will have to consider M&A as a supplement to organic growth. Although these companies are heralded as the great organic growth stories, the reality is they've been hugely acquisitive over many, many years. For example, Google bought Applied Semantics in 2003 for $100 million. Today, Applied Semantics is 20% of Google's business, or an 18 billion turnover business. Looking at Google, many of their best businesses have been acquired. Android, YouTube, DoubleClick, and DeepMind. Even our own John Lewis has done this to some extent. Buy.com in 2001 for 2.8 million was bought on the basis that it may one day represent one store for John Lewis. That acquisition is now half of John Lewis's entire business. We expect to see this continue. We expect to see this trend accelerate. We're starting to see it amongst big cap retail. Walmart, Jet, Sainsbury's Argos, PetSmart, Chewy, and more recently Tesco Booker, all of them looking for exposure to structurally growing markets. Management also have to consider whether these companies can be competed with today. A cursory look at the top 10 businesses in the world shows a huge change in just 10 years. How do you compete? There is an argument to say partner with rather than fight them. One technology company 10 years ago Now the largest 5 businesses in the world are all technology companies. Consider voice. The majors are getting big. Last year, Amazon invested $600 million alone into Alexa. To put that in perspective, M&S only spent $526 million across their entire business. Tesco only spent $1 billion across their entire global business. There's no coincidence that these top 4 logos are the top 4 companies in the world. So what's the point of today? Today, we're in our 4th year of revolution. We're up 30% in attendance year on year, and we set it up to stargaze with real substance at the future of the industry. What I wanted up here were entrepreneurs who've built something who could talk to us and share their learnings with us. The second thing is I wanted to bring together the somewhat disparate ecosystem that traditionally exists within financial markets. So today you'll see a room packed full of retailers, industry stakeholders, entrepreneurs, venture capitalists and broader institutional investors, from 2-person startup to Walmart. I want to thank personally our sponsors. Most of these are long-term true supporters, and I really look forward to delivering ROI today to you. A special thanks to Land Securities, our founding partner, who's been with us since the bedroom days. A thank you from Paul and I to our True team. They're the ones building something truly special for each other. It's a great privilege to work with them and to be part of the team and to watch them blossom and grow. Lastly, it's a great pleasure to introduce you to our keynotes. Zach, part of the founding team of Zappos, head of product, who built a world-class team and business before selling it to Amazon for a cool $1.2 billion. Zach is now founder of VTF Capital, with multiple holdings in e-commerce businesses across the US. He also built a city, as you do by the time you're 35. Simon, twice voted one of the top 50 most influential people in tech, with 20 years defining the changing digital landscape. And Christine, who sold her first business for a mere $850 million and has gone on to create the Netflix of fashion, Gwynnie Bee. I want to thank you all for coming, for being part of the True story. I hope you have a brilliant afternoon and evening, and I challenge you all to leave here with one commercial deal under your belts. As my co-founder constantly reminds me, this business is about outputs, not inputs. It's therefore left to me to introduce Christine, our first keynote speaker, a quite brilliant entrepreneur, and she's here to tell us about her success and the building of Gwynnie Bee. Thanks very much.